It's Sunday, December 4th, 2022. This is all about your Benjamins and your weekly mixtape. Hope you had a great week. As you can see down below, just a handful of headlines to go through. Let me get them pulled up on my computer screen. So let's get to the headlines that may or may not be impacting your financial plan and portfolio. And we're going to start off with unemployment, which ties us to the Fed, which ties us to interest rates, which you know is a big deal this year. So unemployment for November, the jobless rate came in at 3.7%. The economy actually added 263,000 jobs. So we're still continuing to see that the employment picture is relatively strong, which is not what Jerome Powell and the Fed really want to see. They want to start to see unemployment creep up, the jobs begin to go away, and even have some job losses, which I know is really messed up that that's what they want, but that is how they believe they get inflation to come back down. If less people are making money, less demand, prices come down, inflation comes down. So that's what they're waiting to see, is to see the unemployment picture worsen, unemployment go up, new jobs being added go down. So this reading, while it is good that I like to see people going back, knowing what the Fed is looking for is not necessarily a strong point for them. However, the Fed came out earlier in the week and talked about they were only going to be looking to raise interest rates 50 basis points going forward. So we've been on a 75 basis points, 0.75% raise the last few times. The language coming out this time was that they were going to look to do another increase, but do it at 0.5%, saying that they've done a lot in the short term. They want to see if things are going to be impacting inflation the way they want. Again, the goal is to get it back down to 2%. So they're going to continue to raise, but raise at a little bit slower rate, which is good to see. Most importantly, I don't really care about the number per se, because we'll never know what the right number is. Just the language of, we know we've done a lot. It's going to take some time for those previous rate hikes to impact the economy, impact inflation. So rather than continue to do it super hard, let's pull back a little bit. So I do like to see that they're at least admitting that they know they've done a lot and they want to see how things go. So staying on track for a 0.5% rate increase at the next one. We're going to stay in the economy, but we're going to move to a different area of interest rates, the yield curve. We've talked about this before. You might start seeing more about the inverted yield curve. So basically, the yield curve looks at the interest rates from short-term to long-term bonds, treasuries. And what you would expect to see is the shorter the term, the lower the interest rate, the longer the term, the higher the interest rate. Reason for that being, if you're tying up your money for a longer period of time, you as the investor need to be rewarded for that with longer interest rates. When we have an inverted yield curve, we have the opposite. Short-term interest rates are actually higher than long-term interest rates. And the reason behind that is investors are less certain about the long term, so they're not willing to tie their funds up for a long period of time, so it begins to invert the yield curve. Why is that a big deal? We've talked about this over the years, but an inverted yield curve has historically preceded a recession. So pretty much every recession has been preceded by an inverted yield curve, but not every inverted yield curve has been followed by a recession in the short term. Technically, every inverted yield curve eventually gets followed by a recession. If you think about it, we could have a recession in 3 years. This yield curve today, inverting, would have been followed by it. So it's not a definite cause and effect, but it is a sign that we usually see around a recession. Now, this whole talk of a recession is kind of, we know one is coming. Everybody knows it. One, it's a normal part of the business cycle. I always like to remind people of that, is recessions are normal. They aren't fun, and we shouldn't want them, but they are a normal part of the business cycle, a part of our investing careers. But the definition has been manipulated or changed this year, because the old definition was just 2 or more back-to-back quarters of negative GDP growth, and we've already had that. And the asterisk next to this non-recession right now is that we haven't had the unemployment that the Fed is looking for. Usually a recession, you have the slowing GDP, and you also have people getting laid off. Those two are there. But since we haven't had those layoffs, they're not giving the true definition of this being recession. I don't know if that's right or wrong, but nonetheless, I think that the predictions of a recession coming are not that great. No one's wise for saying that. I think it's pretty much expected. How deep, how long, if that's the unknown, no one really knows. So I just bring up this article in that I'm seeing it start to come back up. They've already talked about the inverted yield curve because it's been there for a little while, but now it's steepening, meaning Basically, it's getting more like this, if you can see this on the video. Higher, short-term interest rates are going higher, the long-term are going lower, so the line is steepening, which is more of a negative view on the interest rate and the meaning of this inverted yield curve. If it was flattening out, that would mean that we're getting back to normal, and long will be going up higher and short will go back low again, but it's getting the opposite. So the way the yield curve is moving is getting more negative and more pessimistic from the investor standpoint. And all that is that's just controlled by investors, supply and demand, driving interest rates around. So just be mindful of that. That's why people will talk about it. That's why they're going to say that yield curve being inverted leads to recession. Every recession has been preceded by it, but not every inverted yield curve has led or has been followed by a recession. So it is possible we could have this inverted yield curve and not see a recession, which I don't think is necessarily the case. And for whatever it's worth, my gut tells me we're much further into the recession and the slowdown and all of this stuff than we might realize, just because it's a little bit different this time. Next, power of diversification. This article talks about the Dow and how it's the darling this year, meaning it's losing less than its other benchmark peers. So the Dow Jones, the 30 stocks that we see quoted on the news every night. We've got the S&P 500, which you should know as well, and the NASDAQ. They are all broad market indexes of the U.S. economy, representing different styles and different types of investing. The way that they're priced is different. The way that they move is different. And some of them, the higher priced stocks have a greater weighting. You can have them equal weight, all these things. But the reason I bring it up is, depending on how you're investing, you have a different experience than your friends and family may be having. If you are all in the NASDAQ is down 27% as of this article. If you were in the Dow only, the Dow is only down 5.5% year to date. And in the middle is the S&P 500, which is down 15%. So even within the U.S., you can see the power of diversification, meaning if you got into the growth phase last year, you went all into technology, and you were heavy in the NASDAQ, you're going to be down more than somebody who was in just the broad-based S&P 500 or going more towards large cap value type stocks that you might find in the Dow. So just even within the U.S., we can see on this one example how diversification can work for you. Now you extrapolate that out over different asset classes, large, small, mid, technology, consumer. You can really go through all of it and see how you can diversify out and how it will change your experience. Could be for the better, could be for the worse. If you were all in the Dow and you decided to add some technology, that would have made your experience this year worse than if you just would have stayed. And it's tough to predict this. It's tough to know. You've seen the periodic table from Callum before with the performance all over the place. It looks like a quilt, and the colors change based off of top to low performing asset classes throughout the year. There's no way to guess it, which is why I think diversification for most of us as investors is the best way to go. And this just highlights how it can help you out and what your experience might look like. And the final one, maybe I should have worked this in earlier when we were talking about inflation and interest rates, but the CEO of Kroger came out and said that they are seeing prices for groceries at their stores begin to stabilize and come down a little bit. Not to pre-inflation levels, but the prices of food are not going up as much, and they're actually coming down a little bit or moderating. So that is a positive. Now, I will say that even if that were to happen, we are having household inflation with food as the boys get older. So prices for food could come down, but because we have to buy more now because they're growing, I don't get to experience that reduction in food costs that might be going on. But I do think that's a positive. So we've had oil come down, gas prices come down, starting to see food prices come down. When you go out to building and things of that sort, we're seeing prices at homes come down as well. So it does look like the inflation is at least slowing and maybe even slowing, coming down and not going up as much. So just some commentary there. All right, that is it for this week. I want to thank you for tuning in. Head down below if you're on the blog and check out a few of the posts from this week, a shortened mixtape down below. And if you're over on YouTube, head on over to the blog and check it all out over at allaboutyourbenjamins.com. So thanks for tuning in. We'll see you all next week. Have a great one, and I'll see you in the next episode.